Hello everyone, welcome to the Introduction to Quantitative Trading lecture. In this lecture I'm going to be talking about what is quantitative trading. As a trader myself, been trading for a couple of years now, I have gone to the point where I've realized that quant trading or automated trading is better than manual trading, right? So all of us are human beings, and if you've had a bit of experience in trading, you realize that your emotions are really getting you out of the way. You're blowing your account just because you're actually not being able to respect your own rules, or maybe you don't even have any rules. And quantitative trading is the exact opposite of that. You do the research, you allow the computer or the algorithm to do the work for you, right? Everything is objective, everything is done correctly. So let me now start now and let's jump into it. So what is it all about? Quant trading is about finding profitable trading strategies or techniques. The strategies are dependent on data analysis, modeling using either mathematical or statistical based approaches. And it's also about automated trading. So you want the trading to be done automatically. Therefore, in that way, there's no human intervention, there's no human emotion involved. Because when human emotion are involved in the trading, we have tendency to actually be our own enemy. So whenever trading opportunities present themselves, we may or may not take the trade. Whereas having an automated trading setup, the algorithm will always take the trade for you, right? Or you will find out whether the strategy that you want to trade works or not. Now, what are the advantages? Let's jump into that one. So the first one is it allows you to backtest more rigorously and efficiently. The next advantage is that multiple hypotheses can be tested in a relatively short amount of time. Imagine it, right? So if you're programming your algorithms, you're programming your strategies, you can test them in a much shorter period of time because you can allow your strategy to go through the whole data set faster. But if you have to do the backtest yourself manually, it's gonna take time because you have to go through the charts. If your trading strategy is chart based, you have to go through the data, and it's a really rigorous exercise if you have to do it manually. On the other hand, doing it quantitatively speaking, you can test lots of different hypotheses in a short amount of time. Next one is so the algorithm tend to behave consistently, right? So you develop a strategy in a quantitative manner, the algorithm will always have tendency to do what they said to do. The next advantage is a lack of discretionary behavior. That's what I was talking about when I was mentioning that human emotion are involved. Sometimes you have to think about making a decision or taking the decision or not, taking the trade or not. So it's a lot of discretionary behavior there. And the algorithm, the quantitative trading strategy doesn't have that. The next one is that you can use open source software. Open source is software, so you don't really have to spend a lot of money up front to buy software licenses and stuff because there's a lot of software out there. There's R, there's Python. People are doing their own software there that are making available, right? So you can use them to develop or test quantitative trading strategies. Now the disadvantages. Let's talk about that for a minute. So quant trading strategies require skills and expertise in statistics, maths, and programming, right? So you need, once you indulge or you start this journey of developing a quantitative trading strategy, you need to have the required skills. You need to know at least the basics, right? Like the statistics of your trading. You need to know some of the challenges and biases and stuff so that you don't fall into the trap of having a strategy that, apparently looks like it's a good strategy, but once you put the strategy live, it starts eating away your capital. And also, no slack allowed. But those of us that are actually, lazy, we don't want to, we're not really rigorous with the way we do things, well, the disadvantage of developing a quant trading strategy is that no slack is allowed. Like, you need to be disciplined, you need to be rigorous, you need to follow proper tests, you need to make sure that you have a decent amount of data. You need to do lots of important checks, and you can slack with that. Now, what is it about? So it's a combination. You can use machine learning. So nowadays there's a lot of data science and big data, machine learning, artificial intelligence talk and buzz out there. Or you can use those techniques, machine learning techniques, to develop a reliable quant trading strategy. And my previous course is all about that as well. You can also use technical analysis. You can combine that. You can combine mathematical models as well. So you can use the combination of these techniques to come up with a profitable or reliable quantitative trading strategy. All right, now I'm backtesting. Backtesting. So after having developed the strategy, you can say, or written the algorithm, you need to backtest it. You need to check whether the strategy actually works. And the backtesting of the strategy is to see if the strategy has positive expectancy, meaning using past data. Does the strategy make money? Could it have made money in the past? Right, so that's what we mean by positive expectancy. So a return that is positive and not negative. And you also want to figure out, by doing backtesting, whether the strategy has a capability to generate positive return in the future. Right, so by doing that in the past, you get to learn a few things. You get to learn the parameters. You get to optimize the strategy. You get to find out, does the strategy have a chance to generate positive return in the future? And that's what backtesting is all about. Now, in this course, basically, we develop quantitative trading strategies using data, using technical analysis, and also we'll backtest it with historical data, and we'll see what the equity curve looks like, etc. All right, guys, this is the end of this lecture. Thank you very much, and I'll see you in the next lecture. Bye.